But tonight's presentation, and I want to thank Brian for taking the time. He's a really busy guy. But Brian Hinkle, he's going to talk about 2025 tax update and the presidential election. Very timely. Although we were kind of thinking with what's going on, maybe right after the election would have been better. Brian is a founding member of Sigma Legal Advisors. I knew him though when he was at Meddy Evans in Woodside, which is actually in the building I'm in now. In fact, it's Brian who got me into the building I am now. He called me, told me the suite upstairs was available and I would probably like it, and he was correct.
Then I promptly left.
Yeah, he left me right after. What a guy. I should tell you, he and I ski regularly together. Brian skis a little differently than I do. I go and ski at Ski Round Top. Brian gets there early and hikes up on his skis to the top of Ski Round Top, takes a run down and hikes back up until they open Ski Round Top. Then he usually takes a cup of coffee and then joins us for regular skiing, followed by a fabulous tailgate that he puts on at the trunk of his car. So that's our usual Saturday and sometimes Sunday at Ski Round Top. But Brian is a tax attorney and expert on taxes. He also works in trust area, elder care. And so, Brian, I'm going to turn it over to you and let you go ahead and talk about the current tax situation.
The difference for those of you that were here last year for this same presentation was we were using anticipated numbers last year. The IRS, I waited as long as I possibly could to put this out. So these are all the official tax brackets for this year. I should just point out to start with that according to Bloomberg Tax and Accounting, which is where we tax lawyers get most of our information from, it's probably the most accurate place to obtain tax information other than trying to get it from the major news outlets. The inflation adjusted amounts in the tax code increased this year by 2.8% from 2024. So just a little bit of for comparison purposes, it was 5.4% from 2023 to 2024 and 7.1% from 2022 to 2023. That's basically inflation that you're seeing there. So the largest inflationary increase occurred from 2022 into 2023, and it has been coming down since. You know, from a economics, I'm not an economics person. I'm not a financial advisor. I can say anecdotally, you know, we are starting, and at least in our business, and what we're seeing is inflation in general is coming down. I do believe, and if you would ask Doug or any other financial advisor, you know, I think what you'll find is that inflation is kind of still very sticky in certain areas of the economy, certain things. The big one that comes up very frequently right now, I believe, is probably groceries. And there's some other things that are still kind of high in price, artificially high in price, because that inflation's just not, it's not going away in certain sectors of the economy. So, you know,
That's different.
it is a slight decrease again, 4% to 2.8, and it's definitely a big decrease from 7.1 down to 2.8. You know, the way that a lot of these numbers that you see on the screen here work when we talk about income tax brackets, the United States has what's called a progressive tax system. That's not like the liberal side of the Democrat Party progressive. It's progressive in the sense that it moves up and down a continuum from, you know, the lower income tax brackets are taxed at less less percentages, which results in fewer dollars being paid in tax dollars. The lower income you are, it gets progressively higher as it goes along. The opposite of this, which Pennsylvania has, so just to give you guys a little bit of tax policy kind of background, flat tax is the opposite of progressive tax when it comes to income taxation. Pennsylvania's income tax is a flat tax at 3.07%. That's pretty much everything except obviously qualified retirement plan distributions. So pensions, 401ks, IRAs, things like that, SEPs are not going to be subject to that 3.07% income tax in Pennsylvania. But again, that's kind of the difference between flat taxing from $1 with very little deductions. Because if you look at your Pennsylvania, your PA 40, your tax return, the PA 40, your taxable income for PA purposes is usually higher than it is for federal purposes, except for the fact if you get most of your income from qualified retirement plans, then it might actually be lower. For those of you that are still working, you usually see it on the inverse of it, which is that you have higher income in Pennsylvania because they allow fewer deductions because there is a flat tax. So that is a flat tax versus a progressive tax system. So whenever you see these income tax brackets, you're looking at this is a progressive tax system here as opposed to the flat tax. So you know, don't need to dig into this too much. It is a common misunderstanding though that the ultra wealthy or the people that are earning the highest income, when I say income, I mean ordinary income, which is what we're looking at here, are paying the least amount of taxes. That's kind of a misnomer, and it's kind of a catchy phrase that politicians like to use, especially if they're trying to push a higher tax regime on as part of their platform. What they mean to say is people that have the ultra wealthy that don't typically derive their income from earned income, ordinary income like this, what you're looking at, these tax brackets, they're talking more on the capital gains tax side of things, unrealized and realized gains. So, I mean, as you can see here, I mean, if you earn $626,000, you will have written a check for $188,000 in taxes at that point, and 37% of anything over that amount. So the rich are still paying taxes. It's just some of them pay it differently. We'll get to the capital gains tax, which is something everybody's probably very in tune with. Married filing jointly, again, these I should note too, actually, these income tax brackets are a little bit on the low side right now, and that is because of the Tax Cuts and Jobs Act that was passed in 2017. Now that was when Trump was president, and he had both Republican House, Republican Senate. So it was easy for him to get a tax package pushed through on what they call a reconciliation bill. That pretty much overall pushed the progressive brackets down, and it made it so that the 12%, it actually pushed it down from about 39.5% was the top bracket to 37%. So if you can see here, married filing jointly taxpayers, they don't hit a 37% tax bracket until they're over $750,000 in income. That changed dramatically, post Tax Cuts and Jobs Act, and put a pin in the Tax Cuts and Jobs Act because we're going to be back to that a bunch of times tonight. So married filing separately, probably one of the most misunderstood tax filings. Works for some people, doesn't work for others. Still, again, if you notice, 37% is still the highest tax bracket across all of these. Head of household's a little bit different. Again, still 37%. Now, when we get to trusts and estates, so trusts and estates are their own entity that typically they're their own entity and they pay their own taxes. There are some exceptions to that rule with respect to trusts, and I mean with respect to estates. Income that's passed out of estates or income that is passed out of trusts is typically taxed to the individual who receives it. So if you take a distribution from an estate or from a trust that you're a beneficiary of, typically if there's any tax owed on that distribution and the income tax associated with the money that's distributed to you, typically you'll be issued a K-1 and you'll be claiming that on your own personal income tax return. Likewise, if you have a revocable trust, that would not be subject to these tax brackets here because you're the owner of that for income tax purposes, which means that any income tax on a revocable trust would be reported on your personal income tax return, and it's subject to the income tax brackets that we just went through. Another example of a type of trust that you might see that is not subject to tax at the trust levels that are on the screen in front of us would be a grantor trust. So that is a type of trust that you might be the owner of. It could be an irrevocable trust, and a lot of times we use these in elder law planning, for asset protection purposes. We use them for the business owners that want to engage in sales of their company but don't want to give up control of the company, especially if they're selling it to their kids or to a key employee. A grantor trust is a type of trust that you're the owner of. The person that makes the trust, the grantor, is the owner of for income tax purposes, and it shows all the income that's actually earned by the trust shows up on their income tax return, their personal income tax return, but they don't actually have access to it. So it's kind of a tricky situation. It's a tool in a very, very large toolbox that we have. But these rates that I'm showing you on the screen here, and I want to show you the difference between how these progressive tax systems really work. A lot of people don't understand this. If they see this slide versus, any of these slides, the first thing you're going to notice is, well, oh my God, Brian, there's only 4 lines on this one, and there's many, many more lines on that one. Why is that? Well, the federal government has decided that it's not good to hold money income up inside of trusts and estates. So this is their way of trying to dissuade people from doing that. And again, there's lots of exceptions to a lot of rules, and we have lots of tools in our toolkit to make trusts and estates very tax efficient for our clients. But if you don't do it correctly, you can see here that you hit top income tax rates at 37% at $15,000 inside of a trust versus a single taxpayer that only hits that at $626,000 in income. So if you're the beneficiary of a trust and your trust has $600,000 in income, would you rather that income be taxed inside of the trust, or would you rather it be taxed to you individually? The answer is, unless you really enjoy giving money to the government, you're going to want it taxed to you individually. So people that have trusts and that are beneficiaries of irrevocable trusts in particular, and beneficiaries of estates, especially if it's an estate that is going to be going on for more than the normal 1 to 2 year period that estates usually take to wrap up, you want to have very, very detailed conversations, for lack of a better word, with your tax advisors, because any income that gets inadvertently hung up inside of a trust or an estate and it's subject to tax inside of that trust or estate, as you can see here, it's very inefficient from a tax standpoint. You're going to pay $3,700 on the first $15,000, and then you pay 37% on every dollar more than that. It's pretty insane. Those numbers can get large very quickly. So if you're the beneficiary of an irrevocable trust and you're not taking income distributions regularly, you should take a very close look at that trust. Or if you're not the owner of it for income tax purposes, if it's a grantor trust that you created, you should be claiming that income tax. To the extent that it's not distributed to the beneficiary, it should be claimed on your personal income tax return. Now, this is the interesting one here. I have a couple of notes. We're gonna talk a little bit about this because capital gains tax. No, one thing, if I could go back actually, and this is where Doug and his team are gonna come in. Since most of you would fall probably into that category or that category, knowing that income tax rates are likely to increase in the future, and I'll explain why that's the case. 2024, between now and the end of the year, and 2025, assuming they don't change the law before the end of 2025, would be a very good time to start taking a look at Roth conversions. Chances are that your income tax rate after 2025 is going to go up. So if you can convert to Roth at a lower income tax rate now, you probably should take advantage of that. That is not official advice, but it is my gut feeling. And, I think a lot of advisors, CPAs, financial advisors, attorneys, tax attorneys, whoever you ask, would tend to agree with that statement. The Roth conversion is a pretty powerful tool if used correctly. The last couple of years have been kind of beneficial for that. Since 2018 forward, not everybody's been doing it. It's still kind of, and some people are doing it at a very slow rate. You're starting to see things pick up a little bit. The only thing I'll say about it is this. There are a lot of people that truly believe or truly don't trust the government to allow Roth accounts to continue the way that they're continuing. I'm not one of those people. I think that it would be highly unconstitutional for the US government to go back on that and change the rules with respect to Roths. I am, however, in the camp of people that does believe that, between now and the beginning of 2026, if you're not at least considering Roth conversions, you should be having a conversation about it at this point. It's not right for everybody. And that's the key. It's very fact driven. So you definitely want to have that conversation with your financial advisor. And if you have the stomach for paying some taxes now, and you believe that tax rates are only going to go up in the future, it's probably not a bad idea to at least consider doing some Roth conversions at this point. I'll leave it at that. That's something that Doug and his team can certainly talk to you more about. Capital gains tax rates. Going back to what I said earlier, capital gains tax is it's a very I don't want to say misunderstood. Most of the time when politicians are pining for taxing the rich, they're not necessarily talking about raising income taxes. They're talking about capital gains taxes. Capital gains tax is a tax that obviously you don't pay until you realize the gain. And that's an important word that we're going to get back to. But you have to actually sell something and make a gain to owe capital gains tax. And then you get to offset it with any losses that you might have. As you can see here, there are basically three tax brackets with capital gains tax. There's 0, there's 15, and there's 20. Anybody whose income is below, any single taxpayers whose income is below $48,000 and they realize any capital gains, they are not going to pay any capital gains tax at that point. Anybody that has earned income over $48,000 but less than $533,000, you're going to end up in a situation where you will only owe 15%, and then when you get over the 15%, or when you get over $533,000, that's when you get into the 20%. And then there's also this thing called net investment income tax on top of that, which is currently 3.8%. And they tack on top of that. So basically the top capital gains tax rates are 23.8%. Plus on top of that, Pennsylvania taxes that at 3.07%. So really you're paying 27-ish, 28% in total cap gains tax if you realize something and you're in that highest bracket. What you may notice too is that the married filing separately is a little bit lower. It doesn't really correspond so well to the single taxpayer. So you're almost better off not being married if you're filing separately. And it's a quirky thing in the tax code. Personal exemptions and standard deductions. So a couple of thoughts here. So since 2017, when the Tax Cuts and Jobs Act was enacted, personal exemptions are basically out at this point. There are standard deductions, but there's no really personal exemptions anymore. If you remember back, the personal exemptions are you could claim yourself and your spouse and a dependent for your personal exemptions, and it would basically bring your tax bill down by doing that. They no longer Tax Cuts and Jobs Act actually got rid of that. But Tax Cuts and Jobs Act did, though, was it increased the standard deduction amounts. So those of you that might have been itemizing prior to 2017, from 2017 and before, might not be itemizing at this point because, married filing jointly and with the surviving spouse, if your spouse has passed away, you get a $30,000 standard deduction. Most people don't have deductions that go over $30,000, especially since the Tax Cuts and Jobs Act took away a lot of the deductions that we used to have, and they cap, your state and local tax deduction at $10,000 right now. So it's kind of it's an interesting thing. I will say that the vast majority of people, and I think it's something like 62% of filers, saw a reduction in their taxes under the Tax Cuts and Jobs Act. So it does help the majority of Americans. A really neat little trick that I like to talk about, though, when we talk about standard deductions and itemization, is charitable contributions. This is just something that is a little nugget that I want all of you to take away from tonight when it comes to this. If you are making charitable contributions and you want to deduct those charitable contributions and you do not itemize, if you're taking required minimum distributions, you're in luck, because you can essentially do a backdoor deduction by taking your some or all of your required minimum distribution, not taking it personally, contacting the custodian or the administrator, and then basically appointing that or saying, I want you to send it to this charity or that charity. And when they do that, it will not show up as taxable income to you. So if you're giving money to your church out of your pocket every year and you can't deduct it because you don't itemize, you should be doing what's called a qualified charitable distribution, a QCD from your IRA, and you all of a sudden will reduce your taxable income without having to itemize. You'll get the deduction essentially. That is a whole topic for a whole entire whole entire 45 or minute or an hour long conversation, but it's something that your financial advisors can help you do if it's something you're very interested in doing. So that's just something I want you guys to take away. If you look, though, the married filing separately and the single are the same on on these personal income tax, as opposed to when you look back at the capital gains tax rates. Again, tax lawyers, we call it a ghost in the machine. There's weirdness out there. Here they're the same. There they're not. So you would think that married filing separately would be at least what the single taxpayers are, because that's what it is here, but it's not. It's half of what the married filing jointly is. So certain places you see that, certain places you don't. So HSA deductions, they are increasing. They're going to increase this year. They're going to be $4,300 for individuals and $8,500 for families. And anybody over 55 can do an additional $1,000 catch-up contribution. HSAs are extremely powerful if you have one. There's a lot of tricks to be played with HSAs. A little known trick is, obviously, every time you go to the pharmacy, you should be taking your HSA card and swiping it. If you want to use your HSA card to pay for it, swipe it first. It will allow the HSA qualified items to come off the bill first, and it will leave you with the not HSA qualified items on there that you have to use your regular credit card for. The other really interesting thing that a lot of people do, and this is becoming more popular in the younger crowd that have HSAs, is they will continue to just constantly throughout their whole entire working career make maximum contributions to their HSAs, and they will then turn around and they will keep all of their receipts for anything that might be HSA related or eligible item, and they just basically bank all those receipts up. They put them in spreadsheets. They do all types of neat stuff. And then they may go back 10 years later if they need a down payment on a car, or if they need to pay for a kid to go to college, or anything else. They can pull that spreadsheet back up with a whole list of all those HSA qualified items that they paid for but didn't use their HSA to pay for it. And they can take a tax-free distribution from the HSA many, many, many years later. Cumulative. So it's one of those things that people do. I don't agree with it or disagree with it, but we see younger people doing this, people that are in their 40s and 50s, typically ones that have really put a lot of money into these things and have really been fastidious about keeping records. It's a good way to basically just save for your kid for college, and also if you don't ever want to spend it on your kid's college, you always have that money to spend later in life on your own medical care. And it is also an asset that you can leave to your kids too. So HSAs are actually a pretty good thing. I do like them. Ironically, all of our employees here get an HSA, and I'm the only person that's not on the health insurance plan, so I don't get the benefit from it. Everybody else does. Medical and dental expenses always have a floor associated with them. This really comes into play when you're talking about people that are paying for skilled nursing care, or they're required to be in some sort of a facility because of their health reasons. All of your AGI except the first 7.5% is deductible. That's been about the same. It kind of fluctuates between 7.5% and 10%. So it's been 7.5% for a while. And this is all Tax Cuts and Jobs Act related. Excuse me. Tax Cuts and Jobs Act will expire at the end of 2025 if Congress does nothing, though. So all of this stuff will go back. State and local taxes, you have a combined $10,000 deduction cap, what they call the SALT cap, if you've heard about this. Home mortgage interest, you can deduct interest on your mortgage. Right now it's $750. Interest up to costs associated with $750,000 buy, build, or improvement for married taxpayers, and $375 for taxpayers filing separately. Charitable donations, they are currently at 60% of AGI. That did increase from 50% to 60%. That does reflect Trump's view that charities do better with money than government. And it does actually result in a tax cut for wealthy people who like to make very large charitable donations to bring their adjusted gross income down. But that actually increased under the Tax Cuts and Jobs Act, whereas a bunch of other deductions decreased. Casualty and theft losses, you can't deduct anything. So if you live in Florida or North Carolina or any of the federal disaster areas, you can deduct all those things from your adjusted gross income, any of your expenses and any of your losses. But outside of federal disaster areas, you can't do that post Tax Cuts and Jobs Act, which again will expire at the end of 2025. So this will kind of not be an issue if Congress does nothing at this point. We'll touch on that here in a couple of minutes too. Job expenses, miscellaneous deductions, all subject to 2% floor. You can't go over 2% of your AGI for any of the miscellaneous deductions. From a practitioner standpoint, miscellaneous deductions are shady. You shouldn't do it. You should stay away from it unless you have very, very good reason for doing it. It's going to trigger an audit. Federal, state, and gift tax. Here we go. This is the part where everybody starts to kind of pay attention because nobody really truly understands this. A lot of lawyers don't. Only really truly tax lawyers that practice in this area, I think, understand how this works. There are actually 3 different taxes at the federal level from a death tax standpoint. There's the federal estate tax, there's the gift tax, and then there's the generation skipping transfer tax. The federal estate and gift tax are known, the exclusion that you get is known as what's called the unified credit. Every single person on this call has an exemption amount. For 2020, I'm sorry, I forgot to change this slide. For 2025, the federal state tax exclusion amount per person is going to be 13,990,000, or 27,980,000 for a married couple. What that means is you can give away and or die with, or some combination thereof, that much money and not pay a penny in federal estate tax. Okay? Federal estate tax is a 40% tax, essentially. It kicks in when you die with or give away or some combination of those two numbers more than $13.99 million per person. If you die and you don't use your exclusion, it transfers to your spouse, okay? This is one of the provisions of the Tax Cuts and Jobs Act that is going to roll back at the end of 2025 if nothing is done. This is causing a lot of consternation among our ultra wealthy clients because they have the opportunity to give a lot of things away and not pay gift tax on it. And I'm going to get to that in a second here. What's going to happen is it's going to roll back to the pre-2017 levels, which is going to be about $6.5 million per person. So it's going to go from $27.9 million per couple to like $13 million per couple if Congress does absolutely nothing between now and the end of next year. Now, gift tax. Everybody thinks $15,000 is always the number in everybody's mind, but the number for 2025 is actually $19,000. You can give $19,000 to as many people in the world as you like, and you don't have to report it to the government. You can give $19,000 to every single person that you know, and you don't have to report it to the government. And it won't reduce your $13.99 million exclusion because it's what's called the annual exclusion, okay? If you give $19,001 to one person, you have to report all of your gifts below $19,000. But if only one of them is $1 over the $19,000 limit, it will only reduce your $13.99 million exclusion by $1. So you can give your kids more than $19,000. You can give your kids $13.989 million and not pay a penny in gift tax or federal estate tax unless you die with more than $13.99 million in 2025. If, however, you do that and then you die in 2026 and the law has expired, the Tax Cuts and Jobs Act provisions have expired, every dollar that you have in your estate over $6.5 million that you've already given away because you've already used up all of your credit would be taxable at 40%. There's a very large push among the ultra wealthy right now to deal with this. For those of you that may be on the call that have a non-US citizen spouse, your total annual exclusion gifting is $190,000. So you can only give $19,000 to 10 people before you run out of annual exclusion and have to start reporting it to the government. So this is a very, very complex area of law. It's also very, very misunderstood. Suffice it to say that if you want to buy your kid a car or give them a down payment on your house and you're not worth more than $6.5 million as an individual or $13 million as a couple, it's not really going to affect you. And if you technically are supposed to file a gift tax return, a Form 709, I mean, if you don't file it, they're not going to kick your door down and drag you off to tax jail, which isn't really a thing either, which is a common misconception. They just send you to regular jail. So, all right, enough of the really boring stuff. Let's fly through some really neat stuff, and I can answer some questions because I'm sure somebody has some questions. So, a little bit of a disclaimer here. I am not advocating for any one candidate. You could ask me what my political leanings are, and I would never tell you. It'd be very difficult to figure out because I'm not really sure what they are. This information is taken from all over the place. Okay. I tried to take it from left leaning, right leaning, center, as many different places as we possibly can get it. I will tell you though that as tax lawyers, I'll reiterate the fact that a lot of our information comes from Bloomberg. Yes, it's owned by Michael Bloomberg, who is a self-described liberal. It is not a liberal news agency. It is a very matter of fact. It is a financial-based news agency that really only reports on facts. They don't have a lot of commentary. So a lot of the numbers are taken from there. Some are taken from the Tax Foundation, which has been accused of being a little bit right-leaning. I mean, I don't think that to be true. But here we go. In a nutshell, if you ask me how to describe the two candidates and what they are proposing from a tax standpoint, I will not talk about anything else tonight. We will not talk about what their stance is on abortion because abortion has nothing to do with taxes. So we're not going to talk about that. From a tax standpoint, if you ask me, and since I'm the one that has the microphone, I'm going to assume you did. Trump is proposing tax cuts for basically everyone. And the reason I say that is because the Tax Cuts and Jobs Act did just that. It basically was broad-based tax cuts that brought the marginal income tax brackets down. It brought down the capital gains tax brackets and rates. It did things basically across the board. Now, arguably, wealthier people benefited more from that. Well, of course they did, because they have more income to benefit from that. So there is a disproportionate benefit if that's how you want to spin it, okay? On the other side of things, what Harris is proposing is not all that different, except that she's saying, well, I want all these tax cuts, but I want them to skew more towards the lower and middle income than towards the higher income. It's not a even across the board, which by its very nature results in higher income individuals benefiting more. Hers is more of a declining benefit for higher income individuals. We can sit here and debate all night long whether or not which one's the right way to go, but here we go. A lot of these slides I ripped off of other places, so I'm going to use these just as something as really good information for you guys to see. Some of it is not 100% accurate anymore. It changes way too frequently for me to change this every single day, and I'm not going to do it. But I did update my notes though. So if the Tax Cuts and Jobs Act is allowed to expire, the big thing is right now, passed in 2017, went into effect 2018. It's been in effect. It will expire at the end of 2025. It's good for 7 years. Top income tax brackets came down from 39.6 down to 37%. The Biden-Harris administration, we don't really know what Harris's plan is here, because all she will say publicly, at least, and what she's gone on the record as vice president to say, is that she doesn't want to raise taxes on anybody over $400,000. And the Biden-Harris administration's position has always been 37% is too low for the top individual income tax bracket. It should go back to 39.6. So that's a rollback. They're effectively advocating for a rollback of the Tax Cuts and Jobs Act. So that's their position on this. Most of the commentators, though, do still agree, though, that 62% of the population not the population, of income tax filers, people that actually file an income tax return, benefited in some way from the Tax Cuts and Jobs Act, and that the 38% plus or minus that don't really benefit from it are so low income that it didn't do anything for them. It benefited everybody because it cut taxes across the board. So if the Tax Cuts and Jobs Act is allowed to expire without Congress doing anything, because that's what will happen, it has a 7-year lifespan because of the type of bill it is, 62% of the country is going to see a tax increase if something else doesn't replace it. Harris, again, doesn't really say much about this. There's not a ton of information on it, but just in like mid-September this year, Trump did say that one of the things he doesn't like about his own legislation was the state and local cap at $10,000. That could be a play to blue states where, like the New York, New Jersey, California, where there are typically higher state and local taxes. It's hard to tell what he's doing. He might actually disagree with the cap. They've all pretty much commentators are all agree it really doesn't do much. I mean, it doesn't really raise that much money for the federal government, but it is a real tax benefit to people that have very high real estate tax bills on their houses and they can only deduct $10,000 worth of it. I mean, there's lots of places in the country that a 2,000 square foot house might have in excess of $10,000 in taxes. Pretty much right here where I sit in Camp Hill, Pennsylvania, we're like that. So uh, it's pretty close. So that's that. The Tax Cuts and Jobs Act has lots of other things. It has some, I'll talk about federal estate tax and gift tax again, just to kind of reiterate that. When it comes to children and families, I mean, Harris is a little more aggressive on some of the child tax credit side of things. She is proposing, you know, this earned income tax credit that is good. It's basically an increase of the EITC. You know, all of this is really geared again, my prior comments, it's geared at kind of propping up tax breaks at the lower the income, the greater the tax break. Now, she has not said whether these are going to be refundable credits or not, meaning that a refundable credit is a credit that you can get money back from the government that you didn't even pay into the government. We don't know. She hasn't really said anything about that. There are some refundable credits out there right now. What we know though is that she has some sort of a proposal for newborn children would be $6,000. Children 6 through up to 6 years old is $3,600, and it's $3,000 for 6 through 17. That's what she said publicly. I'm not even sure that that's on her website, but it's definitely out there, and she has definitely said it at some point. I did verify that. Trump wants to make permanent the $2,000 child tax credit that was part of the Tax Cuts and Jobs Act. That is that's been like that since 2017, well, into 2018. Trump has thrown a couple of other things into. He's just like 2 weeks ago or 3 weeks ago mentioned deductions for auto loan interest, so interest that you pay on your car loans. You know, from a tax policy perspective, what he's proposing is to basically prop up the auto industry while also lowering the cost of vehicles for families. So it's one of those things where it kind of provides benefit, arguably, to both sides, assuming that the auto industry just doesn't raise the rates on vehicle or the price on vehicles to make up for the difference. I mean, which they very well could do. I mean, that's always the argument where you provide that type of benefit that the business owners, the leaders, the shareholders are going to say, wait a second, this person's now paying $100 less in interest on this vehicle. Why don't I just raise the price by $100 a month more on them and recapture that? You know, they can't stop them from doing that. We hope that businesses wouldn't do that, but there's an argument against that type of incentivization. Just last weekend, I guess, at some rally in New York, Trump said he wants to do a family caregiver tax credit. Haven't seen any other information on that. I think one of his surrogates did say something on Monday that was the effect of, a lot of times in elder law situations, we want to have family members paid by the individual who's not able to maybe get around or maybe live on their own. We'll do what are called family care agreements as a way to get around the assumption that Department of Human Services says that, oh, if mom gives daughter $5,000 a month, the presumption is that it's a gift unless she claims it as taxable income. And there's a written agreement saying, yeah, daughter's taking care of mom and she's charging her $5,000 a month. I think what Trump is trying to do there is to say, and again, this is through some surrogates, that I read a comment about. They're trying to make it so that there's a tax credit so that daughter can claim that as taxable income, so that there is no question what it's for. It's not a gift. It's actually for services rendered, but then turn around and deduct that income from their income taxes, because it's part of the notion of the federal government pays, Medicare or Medicaid reimbursement rates to nursing homes. They'll pay about $12,000 or $11,000 a month to a nursing home from federal funds for somebody that's on Medicaid. Wouldn't it be cheaper to incentivize people to turn their money over to their kids and then not ding them with income tax bills? Trump, I think, is getting this from some of his advisors. I'm not entirely sure that the idea is fully baked, but from a tax policy perspective, I understand it. Again, Harris hasn't said anything about this yet. I suspect it's on her radar screen, or it's on her people's radar screen now. So you might hear something about it between now and Tuesday. There's a very high likelihood of that. So just watch for more information on that. Harris also, one thing I should mention is, this first time home buyer, the first time home buyer credit, she's trying to expand that, or she's proposed expanding it, and she's trying to give first time home buyers a tax credit. I think it is a refundable, I believe, a refundable tax credit of $25,000. Basically, they get a $25,000 tax credit for buying their first house, and they get that back in the form of a refund. The only problem with that is the same problem with the automakers and deducting the loan interest, is that if home builders decide all of a sudden all these starter homes that we're building, well, we're just going to raise the price on them by $25,000. Whether that's real or not, I don't know. I mean, it's a tax policy argument that academics will kick around. Certainly has the potential of occurring. When it comes to federal, state, and gift tax, like I said before, Trump and his camp want Tax Cuts and Jobs Act to stay in place. They want to extend these increased exclusions. Harris doesn't have a proposal formally, although she has said that she wants to see the Tax Cuts and Jobs Act go away, except for certain things, or she wants to modify it. She did, however, endorse a proposal. It was the American Housing and Economic Mobility Act of 2024. I think it was a bill that was sponsored, if I remember correctly, by Elizabeth Warren. And that would have reduced the federal estate tax exclusion to $3.5 million. She actually brought that back up. She supported that, and that was in 2024. In 2019, when she was running for president, she also penned an op-ed in the Washington Post, which, by the way, has all types of, controversy floating around it, because Jeff Bezos wouldn't allow their editors to endorse a candidate this year. Jeff Bezos owns the Washington Post as well as Amazon. That she had actually suggested at one point in that op-ed that they could increase federal estate tax. They could make it more broadly applicable, and then use the tax dollars collected, earmark them specifically for paying for teachers. I mean, yeah, people say lots of things. Whether or not any of it ever becomes law, business tax incentives. We'll fly through these last few here, just because we started a little bit late, and I wanted to make this about 45 minutes. Tariffs are something that a lot of people are talking about right now. Trump has proposed a baseline tariff on all imports between 10 and 20%, 60% on everything coming in from China. And he has said he wants to replace personal income taxes with tariffs. I don't think that's an off the cuff. He said that during the Economic Club of Chicago, where he was debating the editor-in-chief of Bloomberg. Nobody actually thinks that that's going to happen. I think he's trying to make a point. It sounds like. I think he's taking things to their logical conclusion. I will say this. I think his tariff remarks are kind of misunderstood. I think economists will give you two different views on this, because a tariff really is a tax. So what we can determine he's saying based off of what he said, at least at this point, is that he's arguing that tariffs should be used as a stick, and the carrot is onshore US production. So he doesn't want to be, he wants to encourage businesses to bring manufacturing back to the United States. And the way he proposes to do that is to make it so that it's the same cost to produce it overseas and bring it into the United States because of the tariff as it would be for them just to produce it here. So, yeah, it would theoretically increase costs on US consumers. There's that. What economists don't know is what impact this would have on the broader economy, and if it would lift wages up and lift incomes up and lift wealth up across the broader economy. It, is it a bad thing? That's the question that economists struggle with. Is it a bad thing that they're proposing these tariffs as a way to level the playing field? Ironically, Harris in the Biden administration in particular kind of did the same exact thing. I mean, they didn't all of the tariffs that were put in place by Trump during his administration, they didn't get rid of them when they came into power. And in fact, this last May, they doubled down on the Chinese tariffs, so they increased them even more. So, I don't think Trump and Harris are actually all that far apart on these things. And actually, Jennifer Granholm, the energy secretary, spoke at the PA Chamber dinner a couple months, 4 weeks ago, and she wouldn't use the word tariff, but she's basically saying the same thing as what the Trump camp is saying. They're just using different words. So I personally, I don't believe either side, or I don't know what they're. I'm not really sure what they're saying. I mean, I got the idea that they're using it as a stick to try to bring back manufacturing, but that's about as far as I can go from figuring it out. Harris has proposed startup deductions for startup companies that range from $5,000 to $50,000. We don't really know what that means. She wants to simplify the filing process for taxes for small businesses. We don't really know what that means. They didn't really say much. The bottom line, I think, here is this. Oh, the one other thing too, the America Forward tax credit. There aren't really any details on this, but she did mention AI, aerospace, biotech, data centers, and iron and steel manufacturing as businesses that would benefit from this key strategic investment. And basically, it's the opposite of a tariff. They're trying to give them tax breaks to onshore production. So it's nobody's really sure what she means by that. I think you're going to hear more about that maybe in the next couple of days, because again, I don't think her and Trump are all that far off. They're saying the same things. They're just saying it differently. She's proposing tax credits. Trump's proposing a lower income tax rate, bringing it down from 21% to 15%, and then also no tariffs if you onshore manufacturing, whereas Harris is saying higher income tax rates, but other industries that have a lot of offshore production, we're going to give you tax credits to come back here. So that's why the economists are really struggling with this, and tax lawyers don't understand it either, because I don't think that, quite frankly, either one of their campaigns really understand it at this point. All we know is that Harris favors increasing the corporate income tax rate. Trump agrees, really favors decreasing it, especially for US domestic production. And the tariffs weave in there somehow because they're going to use them to try to incentivize people to bring their companies back to the United States. Capital gains tax. This is one that I just want to say one thing about. Trump hasn't proposed any changes. He wants Tax Cuts and Jobs Act to stay in place. He's okay with current levels. he said during his rallies that's what he'd do. Harris has talked about increasing capital gains tax. She's talked about increasing the net investment income tax from 3.8 to 5.0 percent for anybody that's over $400,000. She didn't say whether that's ordinary income or ordinary income and capital gains combined. We don't know. The one very scary thing that Harris proposed, this falls kind of in the camp of Trump proposing to do away with personal income taxes through the use of tariffs. Harris said something and has continued to say it, and it's a little bit scary. She's proposing for people over $100 million worth of net worth that the US government can tax unrealized gains in their investments, meaning that the US government can basically set up toll booths. This is a super scary proposal. Even her supporters like Mark Cuban have come out and said that if she actually tries to do this, they'll turn on her. And they will very quickly because the economists, again, they don't know what impact that has. Anecdotally, I believe it would have I think I side with the majority of the economists and the billionaires who are going to be the ones that are subject to this tax, that it would absolutely destroy any sense of entrepreneurship in the United States, and it might disincentivize people from really shooting for the sky. What that actually translates to in terms of economy, I have no idea. They say it would definitely, they being the majority of economists that I've seen, think it would be a very big wet blanket on the overall US economy, especially in the tech industry, which is really blossoming in the United States finally in the last 10 years. So I think it's very unrealistic, and I don't think she would ever get that, even if she did propose it. But Harris has no real tax policies proposed with respect to Social Security. I think she just wants to lump that in with her income tax. Trump wants to he's put this on Truth Social and a couple of other places. I don't know if he said it in a rally. He hasn't said it in an interview that I can find, but there's definitely tweets or whatever it's called on Truth Social where he has said that households shouldn't have to pay tax on Social Security benefits if they earn between 63,000 and 200,000. I think the 63,000 number comes from the fact that most people below $63,000 pay almost no personal income tax anyways. I'm not really sure what he meant by that, but I'm pretty sure that's what that is. So basically, the vast majority of people that collect Social Security as their primary retirement income probably would not. And even people that have to take pretty sizable RMDs would not be paying income tax on their Social Security. Tips, you guys probably all heard this. Trump says in June, don't want to tax tips. Harris says in August, don't want to tax tips. How much of an impact is that going to have? I mean, to 16-year-olds and, probably a lot. I mean, I don't, no economist, nobody's been able to say how much that's really that's a play for voters more than anything. It's not going to raise money. The federal government's not going to lose money. It's going to kind of be tax neutral. Overtime, Harris hasn't said anything about it. Trump says he wants to exempt overtime. The problem with that is, and actually I was just talking to my partners about this, we're going to all go to hourly wages and pay ourselves minimum wage and have all of our compensation paid in overtime. If no more salaries, we're going straight out. We're going to be hourly attorneys. We bill hourly. We're going hourly wages, and everything's going to be overtime. And I'm not going to pay any income taxes anymore. It's unrealistic. I don't know how they would do it. Alabama did it I don't know how, I'm not familiar with that legislation. I think it's wholly unrealistic, so. All right, takeaways. All right. Most commentators agree. I have to read this. This is my caveat at the end of all of this. Both of their proposals that they talk about publicly will raise the deficit. They do not agree on how much. Some say Trump's will be $8 million more in deficit. Some say it will be 4. Some say Harris's will raise the deficit by $8 million. Some say it's 4. They don't know because neither one of them has any real firm policy proposals. I mean, Trump tends to have more because a lot of his proposals are based off of legislation that he enacted when he was president. That's still it's still there, the Tax Cuts and Jobs Act. But here's the bottom line with all of this, and this should take a lot of the noise away for you. All of these proposals, like the vast majority of these proposals, require Congress to go along with them. So, if there's divided House and Senate, if you've got Republican House and Democrat Senate or vice versa, doesn't matter who the president is, it's very unlikely they're going to get any sort of like fringe or aggressive or crazy tax plans through. Tax stuff is usually very collaborative. So, all these people that are losing sleep and riding high with anxiety going into this election that, the sky is going to fall if Trump wins or if Harris wins. And it's very difficult for them because of the form of government that we have to really enact sweeping changes without the other side agreeing with it. The exception to that being is that if the president, the House, and the Senate all go Republican or all go Democrat, it makes it a lot easier. And then you get things like the Tax Cuts and Jobs Act in 2017. So please take that away. Don't lose any sleep over anything that was said tonight, please, or anything you hear, especially on the internet or from, I hate to say this, mainstream media these days. Sound bites are not good ways to get your tax policy information. A lot of this information that I'm getting here, I had to dig and look all over the place to find it. And I try to be as balanced and I've been looking at this stuff. People have been asking questions for the last 6 weeks. If you hear my voice is a little hoarse, it's because we have this conversation 16 times a day.